Entering transactions into ledger account. Before I move into the chapter further, I'd like to draw two T accounts. Have a look. Left hand side debit, right hand side credit. Another one is left hand side debit, right hand side credit. Now every transaction has got two effects. We said one debit, one credit. Let's assume rent paid. Rent paid by check £200. Yes, so what is happening? Rent is an expense. You need to open a rent account and it's an expense. Expenses are debit, right? And paid by check means your bank is going down. So another bank account, you need to make it credit because bank is a current asset, it's going down. So how do you do it? Rent, we said debit, right on the debit side. The first amount, this is the amount. It's a 3-column, as you know, date, detail, money. Again, date, detail, money. So or in AAT is just says detail and money and detail and money. You remember date column is at the first one anyway, if it is given or not, but date column is there. So rent written on the debit side 200, rent debit, and written on the credit side for bank credit. That's how you do it. When you write in the detail you write the opposite account's name. Here you write bank, there you write rent. And you do these for every bit of the T accounts. Okay, by this time you should know the increase decrease. So here asset account, e.g. bank, if it is a bank, if it goes up debit, goes down credit. Liability account, for example bank loan, if it goes up credit, just like debt click or Pulse, you remember. Capital is a credit account, expenses are debit account, incomes are credit account. So increase on the credit side, decrease on the debit side. Let's go over this illustration. Number 3, a business bought some goods for cash. So what is happening with your purchases? Purchases up and cash down. So purchase debit, purchase bought goods debit, and cash credit. That has been happening here. Cash on the credit side and purchases you write on the debit side. Inside the detail you write opposite account's name, right? Let's do this activity 2. A business sells goods 200, customer who pays in cash. So cash is going up, DR, cash account debit, and sales ever credit, isn't it? So if you meant to do cash, this is the one, debit, and sales credit. And in the ledger account, T accounts, you've got to open a cash T account, DR and CR. We said cash debit, so write the figure here. And sales account credit, write the figure. That's how at first you identify debit, credit, and then in the detail you write opposite accounts. Then here you write cash, there you write sales. That's how you do your ledger accounts. You can check my other videos from YouTube to record it. And one more thing you need to remember, that once you open a T account, whether for cash, bank, sales, you don't open another T account of the same sales. For sales you don't open another one. You can carry it on different dates. Yeah, we will see it on different occasions. Illustration number 4, recording transactions in general ledger accounts. Ben Charles set up a business 1st of May, 10,000 in cash. So cash, business, what is happening with the business? Cash going up and capital going up. Capital is a credit account, right? So cash increase, capital increase, cash debit, capital credit. That is being shown here. And of course we can prove it through the accounting equation. Then they are going to buy purchases from this cash. So purchases are goods bought, goods purchases are debit, purchase, debit, and cash going down, credit. So you open a purchase cash account. We already had some money. Then purchase you cash credit, purchase debit. So can you see from 10,000, 1,000 gone? How much is balancing if you keep some accounts in your head? In your cash, 9,000 left here. You can think that way. Then buy some goods for resale on credit. Now you are not going to lose cash, but some liability is going to be occurred. Yeah, so purchase as usual debit, and PLC, purchase ledger control account, liability, current liability is credit. You need to open a PLC account. You see, purchase account debit, we're doing in the same account. Yeah? PLCA credit. Then Ben pays rent. Rent is an expense debit, and cash being by cash going down. So rent debit, cash credit. We are going to open a rent account new, but cash old one on the credit side, and rent account on the debit side. Sales of 1,500 cash are made by selling some of the goods. So sales is ever credit, sales account credit, and you're getting cash up debit. So in the cash account we already have it, cash debit, and sales account we opened a credit. In the detail we write opposite accounts name. That is the normal rule. Sales on credit means you're not getting paid now, it's an SLCA or trade receivables being occurred, right? So here your sales again credit and SLCA debit. SLCA is a current asset. Sales account we already have some cash, now credit sales, and it goes into the SL account, individual account. Sales credit and sales ledger control. If it is so many, control. If it is a one person, sales ledger could have said. But anyway, sales ledger control debit, SLCA, or trade receivables debit. Then number 7, transaction number 7. Ben takes out 500 from the cash for his own living. Anything for own personal items you're taking from the business is drawings, right? You remember drawings, and drawings is ever debit. Drawings debit, and cash is going down, cash credit. So cash credit, and you need to open a drawings account because we never had a drawings account. Drawings debit. Number 8, Ben pays his credit supplier cash. Cash going down, isn't he? Also liability going down. So cash going down, cash credit. Liability is a credit account. Going down means it's debit. So the cash we write on the credit side. PLCA, purchase ledger control, which we used to be liable to our payables by 2000. We paid 1500 cash. We are now liable 500. That is called balancing figure, which I'm going to show you later on. Ben's credit customer pays cash, so cash going up, cash is debit, and SLCA, the customer's owing going down, isn't he? Yeah, that's why SLCA credit. Both of the accounts are opened. We don't need to open it. In the old one, we can do a cash debit and SLCA credit. Well, let's go over this activity 3. Let's do it together, and then I'm going to end this video. Activity 3, all about T accounts, recording transactions in general ledger. How many? 8 transactions given. Every transaction has got dual effect. One debit with the equal amount of money, another one would be credit account. Let's quickly identify what would be debit, what would be credit. Started business depositing 20,000 in the bank. What is happening? Who started the business? The owner, isn't he? Who's the owner? Let's see. First week of Hampton, trading up Hampton. Hampton is the owner, has introduced some money from his personal belongings. There's a capital. Capital is credit, and a business is getting money, bank account, debit. That is my double entry, first one. So let's do it, yeah? Let's straight away do it. Bank debit, capital credit. By 20,000. This is my bank account already being drawn. 20,000 bank debit, capital credit 20,000. In the detail, what do you write? Tell me. Here, you write capital. There, you write bank. Your first one is done. Next one, bought goods for resale purposes. Paying by check. Bought goods means purchase account, and purchases are, yes, debit. Purchases are debit, 250 debit. And you paid by check, you remember? You paid by check, bank going down. So bank credit, 250. What do you write in the detail? Opposite accounts name, purchase. And the other one you write bank. Hope it makes sense. Moving on to number 3. Paid rent 225 by check. So rent expense DR and bank going down, bank CR. We'll write on the bank side 225. Rent debit going to be. Right? Bank in the detail. Over there, rent we've written already. Number 3 done. So sold goods, customer paid in cash. Sales is credit account, and cash is debit for this one because money in 657. So do you have any cash? No, we need to open a cash account. Cash. Sales credit and cash debit 657 we said and 657. Here you write sales, just like opposite account name we write it. There you write cash. Yeah. Here number 4 done. Number 5, paid rates 135 by check, bank going down, bank credit, right? And rates is an expense debit. So 135 here about, you write rates in the detail and the rates on the debit side, rates account. 135 right bank, don't you? See, that's how you do it. Hope you can do other T accounts as well, and transactions. Sold goods on credit. Now it's on credit. Sales account is going to be a credit account. Sales credit. And who is going to be debit? SLCA, isn't it? Yeah. Your SL account or SLC given SLCA. So that would be debit. Let's write it down. 750. Yeah. 750. Where is our sales account? There we go. Sales credit 750. SLCA is a current asset. SLCA debit 750, and you write here sales in the detail. Few more, stay tuned, let's do it. Bought goods resale purpose credit. So bought goods is a purchase account. Purchase accounts are debit, and this is going to be a PLCA. PLCA is credit. How much? 450. 450. So purchase 450 and PLCA. Purchase debit, PLCA credit, right? $450. Inside you write purchase. Okay, I think we have only one, wages. Yeah, maybe we paid cash or bank. We need to see it. Wages paid cash. So wages is debit account. Wages debit. Cash going down. Cash credit. Yep. 75 to remember. So cash 75. And cash credit and wages debit. Oops, hold on. 75. In the detail you write cash. That's all from this video. Check out the next video on further practice on double entry bookkeeping.